Hi guys, I'm Leka Devatha and today we're going to talk about underwriting multifamily deals. Underwriting multifamily is way different than underwriting single family fix and flips or rentals. Today I'm going to walk you through my process of underwriting a multifamily deal, all the different moving parts, and show you a case study of my recent acquisition. So stay tuned for all this and much more, and don't forget to subscribe to this channel. So let's walk through some of the most important factors that you need to understand before underwriting a multifamily deal, starting with the cap rate. Cap rate or capitalization rate of an asset is the net operating income divided by the purchase price of that asset. Now, why is this metric useful? It allows us to make an apples to apples comparison between the performance of two completely different assets. By dividing the income from the purchase price, you're essentially coming up with the percentage of cash flow you're getting if you were to buy this asset all cash. Number two is the current condition of the building. For any real estate investment, investors would like to know what is the amount of money that they need to invest into the building over the coming years to make it rentable and livable. Now, these are called capital investments and can actually make a really good tax deduction strategy. Three is rent. For apartments, rent is king, and knowing how apartments stack up or compare to the market is super critical. Four is vacancy. So a property's vacancy rate is the percentage of property that is unoccupied and is typically expressed as a percentage. For example, if an apartment building has 100 units and they have 10 vacant units, then their vacancy rate is 10%. Now, typically in the Seattle metro, our vacancy rate varies between 3 to 5% for underwriting purposes. In a different submarket, that vacancy rate could go all the way up to 10%. So know your market's vacancy rate before you start underwriting your multifamily deal. Lastly, we have the ROI and IRR. ROI is return on investment, and it indicates the total growth, start to finish of an investment, and the IRR, or the internal rate of return, identifies the annual growth of your investment. So before I walk you through my multifamily case study, I wanted to let you know that the BiggerPockets Rookie Bootcamp is right around the corner. If you haven't checked it out, go sign up, register today. They have a whole topic on multifamily investing. Now let's walk through my multifamily acquisition. So Holden Apartments is a 12-unit apartment building right here in Seattle that I acquired back in March for $2.4 million. Our soft costs, which is our real estate commissions, our escrow fees, and property taxes, etc., came up to about $190K, and our construction cost was $460,000. So how is this deal funded? Two ways. There's the debt portion and also the equity portion. For the debt portion, the bank financed $2.3 million, which we used for acquisition and for rehab, and the equity portion was syndicated from our investors and was used towards the down payment of the acquisition. So what's our business strategy here? Well, renovate all 12 units, implement great property management, and increase our rents to above market rental prices. Our exit strategy for our investors is sell the building in 5 to 7 years with an investor option to invest it back into one of our multifamily Seattle deals. So let's go through the different metrics for this deal. First is the cap rate. So for Holden, the cap rate was a meager 1.78%, but at stabilization, we're going to be at 6%. Now, why was the acquisition cap rate so low? Because the seller priced in the future value add into their sales price. Second is rents. For Holden, rents were so below market that the NOI was $96,000 at acquisition. We're going to take that up to $180,000 once our renovations are done. That's almost a 2x increase in rents. Now, the reason for the low rents was the aging building with literally no updates made to it. So the third metric is capital expenses and condition of the building. And I told you before that our capex for this building was $460K. So what does that include? Because that's a very large capex budget. We're going to do all new exterior siding, decks, roofs. We're going to completely renovate the interiors and also upgrade all the mechanical systems. So new electrical, new plumbing, new heating systems. And that's expensive in this market. Now the fourth metric is vacancy. Although Holden had many long-term tenants, vacancy had been trending at nearly 10%. And this was primarily due to the long turnover of tenants. We should be back at the 3% range once the building is stabilized. So the fifth and final metric is return. returns, the most important metric for our investors. What are the returns going to look like for Holden? We're projecting an 18% IRR over the next 5 years for our investors, which is pretty good for this market. So we literally underwrote this deal for months. Our feasibility took 12 weeks, but in the end, when we closed on the property, we knew that we had bought an absolute gem, a super profitable deal for both our investors and for us. So get those underwriting skills under your belt because you can find some real good properties even in this market. All right, so hope you learned something new from this video. Go follow me on Instagram at Leka Devatha and don't forget to subscribe to this channel for even more amazing content. See you in the next video.